fall fast, recover slow. That's what it feels like, right? So the fall happens relatively fast. Bad news spreads rapid over a period of, I don't know, a year or two. You get very, very fast and big reset. And recovery can be slow because you have to deal with supply-demand forces. The markets have been oversupplied, which is part of the reason why the markets go through corrections. You have too much inventories because of the overbuilding.
It really just comes down to a supply and demand dynamic that you spoke of. There was so much demand in the Sun Belt, interest rates were low, and so now we have that oversupply there, and so it's hard to catch up. Whereas places like the Northeast, there isn't a lot of space to build a whole. Like I grew up in Massachusetts. Like there's not a lot of space to build 300 unit apartment complexes.
The reality is exactly that. It existed in the past, it still exists now.
Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Mike Zlotnik, known as Big Mike. He's the CEO of TF Management Group and has been a full-time real estate fund manager since 2009. He's got over 2 decades of investing experience and specializes in building diversified, risk-adjusted portfolios that generate predictable passive income. So, Mike, there's more here to your bio, but like I said, I much prefer to hear it kind of in your words. So, first of all, thank you for coming on the show today. Thanks for taking the time out to talk with me. I'm looking forward to the conversation.
Thanks, Jason, for having me. Yeah, it's I'm not sure where to start, but I start this way. Obviously, there's a good old James Bond movie called From Russia with Love. I don't come from Russia originally. I come from Moldova, the Republic of the former USSR. I came as a political refugee from the communist empire in 1989. I was almost 18. I settled upstate New York in Rochester, New York, nice and cold. You are from Boston area, so you kind of know snow and cold weather.
Yeah. Been to Rochester a few times. I know it's more snow and more cold even.
Boston is pretty similar. Let me put it this way: you get plenty of snow and plenty of cold. So I've lived pretty much in New York all the time, but I moved to New York City in '96. Went to school upstate New York in Binghamton. Studied math, computer science. Spent almost 15 years in tech career, various technology ventures. Some really great successes and fun, but at some point I was just a little burned out and I wanted to switch. Started investing in real estate passively 2000. And actively went full-time 2009 when it was the right time to switch from a tech executive to an aspiring real estate, basically startup, right? And I never looked back. Just kind of, it's been a learning journey. It's always like this. And so we find ourselves now early 2026, and we do today a lot more predictable, steady income, commercial real estate deals. We do equity and debt. So we'll play as a lender. We'll do also equity investments. Our niche is really sort of being the mini investment bank for real estate or mini private equity firm, where we are not an active operator. When some projects we get involved, we have to, but most of the times we work with investors who want to deploy capital on one side of the spectrum into alternative investments, primarily real estate. And on the other side, you've got active operator sponsors. Generally, we try to work with what I call institutional quality, but not institutional size. It's a lower end of the mid-market. There's a ton of capital out there, and we're not competing with the big boys writing, multi-$100 million checks. Most of our deals need, anywhere from 3-5 to 15-20 million equity in that range. Maybe somewhere in between, 8-10 million is a sweet spot. Same happens on that side, depending on the type of deals. I don't know how exciting it is. Just kind of, it's the boring real estate, but you make it exciting because it's steady, predictable, simple, in contrast to high tech, AI boom, all the exciting stuff, but it's a hit or miss. Very, very different kind of game.
Yeah. definitely a different game. But interesting. I mean, and maybe we get into that here in a minute. But you come from a tech background. I guess a couple things. One, you so you started passive investing in 2000. So I I mean, this doesn't necessarily mean anything, but I didn't even know about it. I didn't know it existed as a thing that you could do. In my mind, doing that in 2000, now it's, pretty mainstream. People have access to it. There's a lot of it on social media. How did you first get into passive investing? How did you get introduced to it? I'm curious because just the time frame of that.
Yeah, so it's not the same passive the way you think today. It's not passive check writing into syndications or funds. It was just more of me acquiring my primary residence as the very first apartment in Brooklyn, New York, right?
Mm-hmm.
And then you buy one, and then you buy more. So I continue to buy some apartments and some small multifamily properties, just because it's near, just because you get to touch it. And it's not a cash flow play. It's really an appreciation play,
Sure.
at least here in New York City.
Yeah.
How do I get started? Well, you got to go find a place to live, right? First you're a renter. I got married, and we had to, get the family going. When I was single, you rent. You get married, you definitely need to settle down. Most of the time, that's when people buy their first place. So I don't know how it wasn't like a purposeful. Hey, I'm just trying to be a passive investor.
Gotcha.
Got to buy an apartment, and then I came across multiple more apartments that was a good price, right? And you can negotiate a good price, and in the city you buy mostly apartments. But it ain't any different from buying an investment house somewhere else when
Right.
you could see you could get at the right price, and just difference between income versus appreciation investing. Coastal markets are very much, appreciating markets. It's not a good income play per se.
Yeah. Yeah, of course. And then 2009, you went full time into the just completely like left the tech career and then just went into fund management at that point. Is that it's an interesting time, of course, in the financial markets of right after the Great Recession or during the Great Recession, I guess you would say. How did that play out, and what was your motivation to do it at that time, and how did that look? I mean, I'm sure right now, in hindsight, it looks like a brilliant move because of what happened afterwards. But how did you make that decision then?
Yeah, it's the story is pretty simple. I have a great friend for many years. He's a tech executive for many years, and we've been friends for a long time. And we were chatting about shorting the market. How can you short the market in real estate? We thought the values were too high, and it wasn't the easy way. And then GFC happened. He said, Mike, there's a way to do a short sale now. You can do a short sale in real estate. I'm like, interesting. So long story short, he kind of Joel at that time, he was in California. That's my friend Joel. He basically came across a bunch of people who were, this is right after GFC, that needed financing to buy deeply discounted houses after the market sort of went through a significant reset. And there was essentially a funding need. It was called transactional funding. They would get a property with the bank approval on a short sale for, let's call it, you're in LA, let's just call it, for 800,000. That house used to be worth, I'm just throwing a number on a table, I don't know, 1.4 million, massive discount, right? The prices collapsed, right? And then the loan could have been $1 million, 800,000 short sale. The bank kind of did a drive-by BPO and didn't even realize that it's really worth like 850. I'm using an example, right? Mm-hmm. So they would lock the asset for 800,000 and immediately have a buyer who was happy to buy from them for 850. So they needed funding to basically close the one transaction and immediately flip the asset for 850. So, that's kind of regional tempo funding started. They start providing transactional funding. It's a bridge loan, for 1, 2, or 3 days. Literally, that's what it was. In California, It was the slowest of them all. It took 3 days to do the whole transaction. You had to fund day one, close first transaction on day two, and the second transaction resale on day three. So long story short, it was 3-day loan, and we started doing those transactional funding loans. That was a regional tempo funding product, and it was pretty hot because a lot of people needed the money to buy from the owner with a short sale approval letter, right? And the owner didn't care because they were so upside down. Whether it's 800, 750, it doesn't make any difference. They wouldn't get any more money because all the money went to bank.
Right.
So owners were flexible to accept, let's just call them, good prices for the buyer. And the buyers flipped these houses, provided financing for a few years. That's how it proceeded. How did it happen? Well, I was in high tech. I was kind of burnt out, tired. And Joel called me and said, hey, Mike, I got this really interesting idea. What do you think? We need funding. We just pull our resources together, get a couple of friends. We just start funding. We don't need a lot of money. We need a couple $1 million to fund because the money is rotating fast. Right. So we started, and then it kept going until banks started putting anti-flip restrictions, as if it made any more money to them. It said, hey, you can't resell the house for 90 days. Why? Because the bank didn't like the fact that somebody else was making a profit while they were, how it works.
Yeah.
So from there, the story continued because we had to do extended funding. Literally, you couldn't flip right away, so you had to hold for 90 days. Now, underwriting changed. You can't fund on transactional funding underwriting. You have to go and fund based on LTV, what the house is worth, a bunch of other things, like a hard money loan, traditional. Right. So we start doing those, and then people had to hold those houses for 30 days, 90 days, 120 days, do a little renovation. We got into essentially hard money lending, and it continued for many years. We still do it today. People fix and flip, right? It's just that business has been around for a long time. It's a perpetual business. But that period of time after GFC was very hot because lots of inventories, people upside down, and the banks are not doing smart appraisals. And it doesn't even matter whether the market was just flooded with inventory. So so it was flip funding, transactional funding, hard money loans, until we kind of got into some of the other commercial strategies.
Yeah, it's great when you have a friend providing a great idea like that. So you never really operated it. I know you said you're not operators, but you were sort of straight from the get-go working in the debt space.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
You become operator when you have to take the asset, right? Then you become an operator. So it happens. If you are in lending space, you will. It's inevitable that you will wind up owning sometimes assets. So
yeah, that's a great point. That's great. So tell me about the kind of evolution of that. So starting with these transactional fundings, and you go to more of a hard money lend on fix and flips. The market shifted, right? We had rates went down. We had the values started to go back up, I guess, towards 2015, late 2010s. How did that evolution of your business go? What was the kind of story going forward from there?
Yeah, in 2017, we launched our first, we ran a few of the debt funds, lending funds, essentially hard money lending funds. And then 2017, we launched our first commercial multi-strategy fund that did commercial equity. So it was anything that made sense. Multifamily, self-storage, industrial, open-air shopping, you name it, right? Debt and equity. So 2017, essentially, we started doing that. And the values were still good. The opportunities were still good. Market continued to improve. It just kind of was a good run all the way through 22, until the market reset. You had a blimp during COVID, but that blimp was short, right? You remember just what happened. It was a shutdown, everything was a panic. In fact, some interesting opportunities became available when, the COVID hit. But that's kind of been the evolution. And then, reset of 22 with interest rates being, fast and furious. They went up and then higher for longer. And, we see a ton of opportunity today with market having reset quite a bit. So fresh capital has a ton of great opportunities. But what we really like is it's like this way. Multifamily has had the biggest reset of them all. For whatever reason, a lot of multifamily was bought with floating rate debt, value add projects. Yep. I don't know how much you know the story, but it's multifamily have had the biggest reset of them all.
Yeah.
Some single families, some residential assets obviously have market shifted quite a bit with oversupply. Multifamily was also oversupplied in a number of markets, as you know. Mm-hmm. But industrial open-air shopping, we've seen those markets to be steady Eddie. They've always been conservative leverage, fixed rate debt. And the beauty about those strategies, for example, so we've done quite a bit more in those, is that they trade on a spread, positive spread between the cap rate and the interest rate. So it's always been the case. When the rates were low, the cap rates were low, but the spread was still positive. As interest rates increased, the cap rates increased too, which improved pricing, right, per dollar of income.
Right. And
the spread still stayed about 150 to 200 basis points, 1.5% to 2%. So that's a great steady spread that you get cash flow from day one. And that's the beauty about that. You use 65% leverage, you use fixed rate debt. You're kind of starting from a safe place. And now if interest rates come down, you're getting great tailwind.
Sure.
That's the theory.
Yeah. No, I mean, I'm always interested in talking with people that were investing in that, 2008, 2000 during the GFC, and have now been through this, sort of recent market reset. Do you feel like, maybe just give us your perspective on the differences and similarities between that time and what we're experiencing now, and I guess continue to experience.
Yeah, the biggest similarity, I would say, fall fast, recover slow. That's what it feels like, right? So the fall happens relatively fast. Bad news spreads, rapid over a period of, a year or two, you get very, very fast and big reset. And recovery can be slow because you have to deal with supply-demand forces. Mm-hmm. And the markets have been oversupplied, which is part of the reason why the markets go through corrections. We have too much inventories, right? There was a lot of inventories then, and then inventories increased and supply increased in multifamily and storage, as an example, in commercial, because of the overbuilding, right? Certain markets, certain cities. So you have to burn through all that excess inventory. They call it absorption rate. All that has to be absorbed over time, and gradually start the recovery. Just seeing relative price versus the dollar of income. Now, multifamily and other asset classes, but multifamily more than any other, has seen very significant cost inflation. Right, so you had insurance inflation. You saw just labor, materials, all that stuff. Yeah. And the difference between, you have to be very specific on the type of asset class, because if you did triple net industrial and it's triple net, all the cost increases a problem of the tenant.
Yeah.
And it's a multi-year lease. Now, if you're dealing with multifamily, it's a year-to-year lease. The market forces dictate what rents you can charge, right, depending on supply demand. And then your costs as an owner are your costs. So again, back to the differences and so similarities and differences. I definitely see a slower recovery. So multifamily is not recovering as fast as people would love to see it recover, but it's a slow recovery path. It is similar to what happened during GFC. But fundamentals are improving, right? Over time, no new supply. You've got still some rent growth. Depends on the market. Right, so if you look at statistical data, you saw negative rent growth in Sunbelt regions, some parts of Florida, Austin, Phoenix, a number of those cities.
Yeah.
And then you saw positive rent growth in Midwest, Northeast. If you've seen, it just depends where the supply demand forces kind of how they work out. So I do see recovery. I just see it's a more gradual recovery. That's a similarity. Difference is, it's a residential versus commercial. So residential is driven a lot more by affordability, and which is a serious issue. You saw a lot less correction when the rate spiked in residential,
Right.
while the affordability didn't really improve. I mean, it's gotten worse. So we're seeing the market adjusting gradually versus in 2008, 9, reset fast across the board on a lot of markets.
Mm-hmm.
And then you've got on the commercial side, you've got, again, the underwriting is based on cap rates. It's an income-based approach versus comps approach for residential properties. So a little different. You just gotta sort of look at the differences of specific market by market, asset class by asset class. You can't really generalize. All real estate is local. That's another conclusion.
Yeah. I mean, I think two things you just pointed out there that I think, I mean, maybe if you're going to learn anything about real estate investing, 2 points you just made, I think might be that should be top of the list. One is real estate is local. You have, very, very different, as you mentioned, the Sun Belt has had negative rent growth. Areas like, New York, New England, I think New Hampshire's been like particularly good in terms of rent growth. So it is hyper local. Also, you could, I guess, lump the asset class into that. Different asset classes are going to respond differently to these market conditions. But overall, I mean, it really just comes down to a supply and demand dynamic that you spoke of. I mean, there was so much demand in the Sun Belt because everybody thought that was the place to be. There were more, I guess, tangible reasons than that. But overall, it was like everybody wanted to buy in the Sun Belt for a number of years. Interest rates were low. And so now we have, that oversupply there. And so it's hard to catch up. Whereas places like the Northeast, there isn't a lot of space to build a whole, like I grew up in Massachusetts. Like there's not a lot of space to build 300 unit apartment complexes. It's happening, but it's just not like you have these massive open areas of land. And so you still have, if you want to live in Boston, you're probably going to be in a 3-family. Like that's very common. It might be a renovated 3-family, but I mean, just what's actually there. But I think, your point about those two particular dynamics are just so important. And you would think we would learn the lessons, right? Like this is basically these market cycles happen for in a lot of ways the same reasons, and you would think we would learn those lessons and it wouldn't keep repeating. But I don't know. So I guess we don't learn easily.
I'll tell you this: it's not we people. It's many individual players that compose a market, and everybody acts in their best interest. And if you think about it, it's Warren Buffett's kind of, theory is be greedy when others are fearful, be fearful when others are greedy. The markets do follow sort of, herd behavior. Sometimes everybody knows, demographic, trends, and you got migration patterns and people leaving California and they're moving to Texas, and they're leaving New York, they're moving to Florida or, Texas, etc. All these things are still happening. But the pendulum overswings, right, in a big way.
Right.
So, and when you're in the middle of it, it's hard to see. People continue to do what they do, and sometimes you just can't see. It's just like when the glasses are on your nose, you can't see you're wearing glasses. So the time has to pass. You have to remove the glasses, put it on your, forehead as a guy who wears glasses, or give it some time, and then you see what's happening. So the reality is exactly that. Like these patterns have taken place in the past. Market cycles, right? The market cycles concept, it existed in the past, it still exists now. And markets go through these 4 phases. They go through the recovery. It happens now. We are in the recovery phase, the early stages of the recovery. Then you get into the expansion. Things are going well. People are enthusiastic. People are buying. Demand is healthy, et cetera, et cetera. At some point, you go into hypersupply, just overbuild. And you're right, New York City, Boston, no space to build. So you've got, generally speaking, rarely ever you have oversupplied. Although you've seen, I've seen the condo market in Manhattan stall because they overbuilt and people can't afford these damn, 5, 10, $15 million condos, right?
Right.
So basic stuff, but they still, affordability can be an issue, and it is an issue in big cities. It continues to be an issue, but you still have a supply side, very limited supply. So market cycles, and then again, the last part of the cycle is a recession, and you hit there when supply demand is out of balance and everybody wants to sell, get out. They fear, if the fear is high now, and then the market crashes, and the fear is super high at that point. But that's the time when you slowly start, have to look and become greedy. But it's a slow process because it takes time, everything to sink in, and for the market to recognize that it's not market, it's individual participants. So that's the theory. As an investor, you just got to recognize these trends and hope, take advantage of the right type of investment strategy in the right part of the market cycle.
Yeah. Yeah. And I mean, it's easy to say that, I guess. It's just, and then maybe that's more my point is we can sit here and say that and know intuitively that it is, Warren Buffett said it's pretty well demonstrated that, sort of taking the contrary play a lot of times to whatever the herd is doing is actually probably going to work out well for you. But yeah, as a whole, that's not that's not happening, or these things wouldn't happen. We'd have a more, I guess, rational investment strategy overall as a society. What do you think? I mean, if we're sticking with that Buffett theory of being greedy when others are fearful, where do you think the maybe contrarian play would be now? Like what do you see as good opportunities to get into, for the coming decade?
Well, decade is a long time, right?
Yeah,
so I don't know if I can, but I can tell you that being a tech guy for many years, I am a little bit nervous, and that AI is the AI valuations are through the roof, and the expectations far exceed the the likely outcomes. So the Magnificent Seven, the stock market performance has been insane. Reminds me a little bit 1999, before the market corrected.
Mm-hmm.
So on a risk reward basis, those markets appear to be somewhat overvalued, if not a lot overvalued. And the reason I mention this is because there are revolutionary technologies. The .com was revolutionary in theory. AI could be revolutionary in, maybe it's different this time, but the pattern's still the same. The investors, the herd, overpays. You don't know when it's the last straw. You don't know when the market cycle will end, but directionally you're approaching the peak of the cycle. So on the stock market side, caution is something that folks should really consider. If they've done incredibly well in that, and literally we have a bunch of investors who have been doing this already, they've taken chips off the table of crypto. They've sold appreciated crypto. They've sold appreciated stock market positions, etc. And what they're doing with that money, they're putting it in these deep value, well-bought projects that we, give you an example, we did open air shopping, and 9.25 cap last August. We did triple net industrial, we just closed at 8.7 cap on purchase. We did a multifamily actually about less than a year ago at 9 cap purchase, already heavily discounted. Yeah. Right. So these deep value acquisitions on a risk reward basis, they provide, in my view, asymmetric return profile. Right. It's just kind of like the way you look at this from a couple of factors. One, they're bought already with cash flow today. Two, they've got margin of safety through the positive spread between the cap rate and the interest rate, the fixed rate debt, the predictability of long-term leases and rent escalation clauses. So you have a very clear, predictable path. And where you could get a lot more upside is if interest rates come down, right? Trump is harping on the rate cuts. The new Fed chair will be dovish. They're talking about installing a new Greenspan, like he was a super dovish guy who will basically keep inflation under control and the interest rates very low. So if those things do happen, real estate is an incredibly attractive asset class. Probably all of it will do well. but certain things I think will do better because you have less risk and complexity versus ground up construction or heavy redevelopment. So what I feel the opportunities to pick up these quality assets with predictable long-term leases and steady path forward with limited risk and limited complexity of execution, and just ride the wave as interest rates come down. And I believe they will gradually over time with new Fed chair, and then inflation itself can come down. I certainly subscribe to this theory that AI is a revolutionary technology. It improves productivity tremendously. With improvement of productivity, you generally have it's a heavily deflationary thing, right? For the same service that used to, you have to pay a lawyer to do these contracts for a whole bunch of money. Now you could have an AI draw your contract. Now, I'm not giving legal advice. You can still do it consultation with a lawyer, but the point is, it's just cost of delivery of a lot of these things are cheaper, right? So as a result, we're probably going to see some level of deflationary pressure, not inflationary. Anti-inflationary, I believe, is what's going to happen in the coming, days and years. And with that in mind, essentially, we might see lower level of interest rates if inflation is not out of control. If you have automation, productivity gains, and many other things that decelerate inflation, you have low level of interest rates, and that's very friendly to real estate. So, but that's a sector statement. As far as the deal selection, we are gravitating to more steady, eddy, predictable, because it's just easier to live. You get cash flow today, you got margin of safety, you get predictability of long-term leases. Because the best way I describe commercial real estate is that there's four primary areas. You got month-to-month rents or lease, right? You got self-storage, it's a month-to-month. You got typically multifamily, which is basically annual, right? You've got commercial, like retail or an office, you got a 5-year lease, maybe a 10-year lease. And then you've got long-term leases, which happen with industrial properties or businesses that want to stay there for long-term, 20-year lease, 25-year leases. And you just got to figure out what are you more comfortable with, simple, predictable, long-term leases, or you want to roll the dice with a little bit more risk and more operating businesses in, self-storage is sort of an operating business. Car wash is an operating business. A senior living facility or multifamily, which is also pretty heavily operating business. People don't want to say it. It's just a lot of work involved managing tenants and toilets.
Yeah.
So.
Yeah. Well, yeah. I mean that's all interesting, and I mean thank you for that. I think there's a lot to, I guess, be worked out over these next couple of years, and what AI will do. Positive and negative. I think it's another one of those things where it's just a lot of fear based around it. Where the same thing with these market cycles is there's just a lot of fear and people reactionary to it rather than, kind of looking at the opportunities. And it sounds like your investment thesis is opportunistic. Is that sound? Would you agree with that statement? I guess is it because various asset classes. It sounds like various markets, but you're just looking for the high value deals ultimately.
Well, what I believe is this, right? So some of the fundamental principles, and I have a great new book that's coming out, and I'll tell folks how they can sign up to get a copy. I believe in fundamentals of investing, right? So diversification is one of these fundamentals. Like Ray Dalio talks about, 10, 12 non-correlated assets as part of your diversified portfolio. Right, so as folks think of the investing, that theory, the general theory of diversification applies. Diversification over various asset classes, also diversification in time, because you don't know if you can time the market. In fact, it's very difficult. So the approach to this is what has done well, should you rebalance your portfolio? And these conversations are natural. People have reached out to me and said, what do I think? I say, I'm not investment advice. I'm not going to give you investment advice, but common sense. The damn Bitcoin went to $120,000 a Bitcoin. And I have friends who sold it and they put some money, into real estate. And on a relative basis, they've done really well. Did they sell all of it? No, they sold like 5%. It was like they think it's going to the moon. You could believe it. I'm not saying don't believe it. Do what feels right, but it's just prudent diversification. So basic diversification always applies, no matter how well you've done. You bought Nvidia stock, right? You are so heavily into that. You have fortune in that. Okay, maybe take some chips off that table, and then consider what is relatively deeper buy. I mean, the rule number one in real estate, what I learned, you make the money on the buy. Right? And how do you make the money on the buy is when you have a high conviction that you're getting a really good price for the type of asset, given everything that's going on. Right? When I bought my first apartment, I had a high conviction that I got a very good deal. Right? And for whatever, I'm not going to explain that. Then I bought many other apartments. Every time I had a high conviction that it was a strong deal. Right? Yeah. So if you have a high conviction with the triple N industrial or shopping or multifamily or storage, you just gotta be very clear why, what are the reasons that it's a strong buy. Then effectively what you just did is you have an asymmetric return profile. This is kind of an investment. Everything has risk, nothing is zero risk. Mm-hmm. But on a relative basis, if you're buying today something at a steep discount, like when we underwrite, we have like multifamily or any other asset class. I have three primary kind of ways to look at this, right? Number one is, as I say, it's the margin of safety. It's the positive spread between the interest rate and the cap rate.
Yeah.
The other way, so the cap rate and the interest rate, right? The positive spread between the cap rate and the interest rate. Some asset classes don't allow you to do that. You just go look at this, and I looked at the storage deals. They're buying it at 5 cap and financing 5.75% cap rate. Like, how can you do that? Well, there's a whole theory, but it's a negative spread. I don't like it. It doesn't feel margin of safety. It feels speculative. Mm-hmm. But if you get into those, as I mentioned, positive spreads, you have a margin of safety. Two, I look at the relative value of the asset, what it was at the peak of the market versus now. It's difficult to know exactly where the market is today. You're looking at the comps, right? But in multifamily, as an example, many assets reset 30 to 40% of the peak. And you can clearly see the price in 22 versus the price now, right? Yep. But you look at the fundamental. We bought the deal. I'll give you an example. Last February, we bought a multifamily assets at 9% cap rate when it used to trade, 6.5 years ago, right? It's a massive discount. Mm-hmm. And it used to trade $125,000 a door. Now it's trading, when we bought it, at $79,000 a door. And you look at the relative rent, the going-in rent before any improvements, now $1,150 a door, you're buying $79,000 a door. Right, so all those things, they're fundamental underwriting conditions, right? They're very basic stuff. You could look at this and you could say, yeah, this feels right. This feels good, right? And then kind of so I mentioned the positive spread. I mentioned the relative price to where the peak was. Mm-hmm. And if you have a well-established market today and you see everything is trading for, $85 a door and you're getting $79 a door, then it's a little discount on the as-is basis, right? But that discount is not easy to establish because transaction volume is low. It's one thing I wanted to say, that the market corrected, the transaction volume has been very low, and it's difficult to know exactly where the market is. The third element, there's a third element to the whole thing, is price per pound relative to reconstruction value. So if you're buying an asset, you're looking at the age and condition of the asset. So we did a deal in 2024. It's a mixed-use property that was bought was built 10 years ago, and it was acquired for about $190,000 a door multifamily asset. And reconstruction cost today in that market in the Washington D.C. is about $400,000 a door.
Yeah.
Right. So you run the math. You're basically buying it below 50% reconstruction cost. You discount maybe 1 or 2% wear and tear per year. I mean, this is the general theory, right? So you could take 400,000 reconstruction and say it's worth now 320 to 360. So it's a 10-year-old property, 1 or 2% per year times 10 years.
Sure.
So it's 10 to 20% discount. So you look at this and say, am I still getting a great deal at $190,000 a door, right? And then all that tells you a great story. Oh, what was the cap rate in that project? On that project, the cap rate used to be like 4.8. It was bought at 6.5 cap, right? So you look at these numbers and they all make sense. Reconstruction cost, the cap rate approach, and then, the spread between the interest rate and the cap rate. It's harder to do multifamily. On that deal, you don't have a massive spread because you're buying at 6.5 and you're financing, let's call it, 6.25. But you kind of live with it because multifamily trades like that in that market. It's a coastal market. Now, if the other multifamily I mentioned that we bought at 9 cap and financed at 7% interest rate, it's Midwest. It's Midwest. It's very different.
Yeah. Yeah. Well, and something you mentioned earlier that I guess I would, at least a lesson I have learned, is just a safe, practical amount of leverage on these deals. So instead of, what was happening in 2021 and early 2022, where everybody had to use bridge debt and you had to really leverage it up to get the numbers to work. Then, I think you mentioned 65% leverage, and you mentioned that the triple net lease tend to have a lower leverage, which I think is
65%, 65, even below. The crazy part, we did a deal with open air shopping, 58% leverage.
Yeah.
And people think, wait a minute, I'm not getting enough upside. Wait a minute. You can actually get the upside. If you bought it right, you don't need crazy leverage to still make really strong numbers.
Right.
Now, the leverage magnifies returns if you're right, but it hurts. It hurts you more if you're wrong.
Right. Yeah. It's the risk of that over leverage is much larger than, anyway, everybody has their own investing appetite, I guess, for risk. So, no, this is great.
65% is a magic number. For some reason, multifamily, you can go to 70, but it was pushed 75, 80, and it was even pushed further with other, mechanisms.
Yeah, absolutely. Mike, well, let me shift gears. I want to make sure I get to ask you the questions I ask every guest and make sure we get a mention of your book as well. But the name of the show is Know Your Why. I do ask every guest, what is your why? You're obviously very intelligent and knowledgeable of the markets and all of that. You've had a lot of success. Kind of what keeps driving you forward?
4 monkeys and a cat. So I have 4 human monkeys. I have 4 kids, and I actually have a cat. My wife, married for many years. So yeah, kind of like some people have mission in life, and when you have a big family, you just want to make sure your kids are successful. So I'm not doing this for no other reason other than I love it. It's just kind of like I want to operate in the genius zone. If I wasn't doing this, what else would I be doing? I don't play golf. I don't, I don't. A lot of things I don't do, but I really enjoy this. So I'm doing this because I really like doing this. This is my genius zone. This is fun. And genius zone are 3 things: something you're good at, something that is profitable, something that you really enjoy doing.
Yeah.
So combination of those 3 things puts you in a position of a genius zone. Family, and I try to help. I try to help those in need as much as like any other guy.
Yeah. No, I do. Operating in that zone of genius it really is. Then you're just enjoying it. You're doing something that gets you fired up, and it's fun and good to kind of work the brain. When people hear this and they want to connect with you, what's the best way for them to reach out and tell us about the book?
Sure. So now it's going to get super easy and super cheesy. I do run a podcast with a cheesy name, and people do call me Big Mike. I am 6'4", and yes, you can't tell it on a video, but I'm 6'4". So
like you're sitting down, so it's a little harder to know that.
Yeah, and my chair is specifically kind of low. I'm just used to this, so it's just that's why you can't tell.
Yeah.
But I run a podcast called Big Mike Fund Podcast. So the website is bigmikefund.com. And if you misspell it, if you forget the D at the end, you go to bigmikefund.com. I promise it's not a kinky site.
Okay, perfect.
So that site is an entry point. People, very easy to remember. We have a corporate site. We have everything else. But the easiest way for people to reach out, go to bigmikefund.com. You could sign up for the book. I think there's a space to sign up for the upcoming book. And also from there, you can navigate the corporate website.
Okay, perfect. What's the title of the book?
So there's been a few different ways to it hasn't come out yet.
Okay.
One of them, there's a possibility it'll be called something like Predictably Wealthy.
Okay.
And it's really about investing predictably, income oriented. But I cover everything from market cycles to different asset classes to understanding leverage to all these basic concepts that we talked about and many more as part of the book. It's a journey book. It's really a journeyman book. It has many stories, just kind of people, successes and failures and lessons learned.
Awesome. Well, we'll be looking forward to that. Mike, thanks for coming on the show today. Thanks for everything that you shared. I learned a ton. I appreciate your perspective and really, very interesting take. That's I love the way you explain things. I think it's probably the best way to say it is I think it's make it easy to understand and make it give people some perspective on different asset classes and market shifts and all of that. So thanks for being here today and sharing all that you did.
Jason, thank you for your kind invitation.
Folks listening, make sure you connect with Mike, get the book when it comes out, and please like, rate, and review the show so we can continue to get great guests. As always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?